Assalamualaikum. My team would like to present about analysis of corporate financial performance, a trend and comparative study of Nestle and Dutch Lady. My group member is me, Muhammad Azarifi Abdul Majid, Nur Salawatun Nadia binti Mak Daud, Nur Hafizah Nizin Denil binti Faziz, Nur Dini binti Zalani. So, let's go.
Assalamualaikum and good evening. My name is Nurdini binti Zalani. Today I would like to present about analysis of corporate financial performance, a trend and comparative study of Nestle and Dutch Lady. First is company background. Dutch Lady. Dutch Lady is a well-known brand that makes dairy products like milk, yogurt, and baby formula. It started in the Netherlands and now owned by Friesland Campina, a big dairy company. Dutch Lady is famous for its high-quality, nutritious product, and you can find their milk in both regular and flavored varieties. They also offer plant-based drinks in some places. The brand's blue packaging and cow logo are easily recognized. Next is Nestle. Nestle Malaysia Berhad, founded in 1912 and based in Petaling Jaya, Malaysia. Produces and sells food and beverage both locally and internationally. Its product range includes ice cream, milk, drinks, coffee, chocolate, noodles, cereal, and nutritious products under popular brands like Milo, Nescafe, KitKat, Maggi, and Nestle. The company operates as a subsidiary of Nestle. Next is Vision and Mission Dutch Lady. Dutch Lady's vision is to be the most trusted dairy brand, while their mission is to provide high-quality, nutritious products that promote health and well-being through sustainable practices. Next is Vision and Mission Nestle. Nestle's vision is to improve life through food and now in the future. Its mission is to offer tasty, nutritious products while focusing on sustainability and creating value for shareholders. Next is conclusion of liquidity ratio. Okay, Nestle has a low and stable current ratio between 0.59 to 0.71, meaning it may struggle to cover short-term liabilities with its current asset. Dutch Lady has a fluctuating current ratio, peaking at 1.575 in 2021 but dropping to 0.799 in 2023, indicating inconsistent liquidity management. Overall, both companies face liquidity challenging, but Dutch Lady shows more variation suggesting potentially instability in short-term financial management. Okay, lastly is conclusion on quick ratio. Nestle has low and fluctuating quick ratio ranging from 0.20 to 0.38, indicating that it has limited liquid asset to cover short-term liabilities. Dutch Lady show a declining trend, dropping from 0.614 in 2029 to 0.321 in 2023, suggesting reduced ability to meet short-term obligations without relying on inventory. Overall, both companies may face liquidity risk, but Dutch Lady's declining trend could indicate increasing financial pressure. Thank you.
Hi, my name is Nur Salawatun Nadia binti Mak Daud. Today we are diving into activity ratios, specifically focusing on account receivable turnover. This metric tells us how efficiently a company collects what's owed to them. We will be comparing two companies, Nestle and Dutch Lady, over a 5-year period from 2019 to 2023. Account receivable turnover is calculated by dividing sales by account receivable. Let's start with Nestle. As you can see, their account receivable turnover has steadily increased over the years. In 2019, it was 10.86 times. By 2023, it had risen to an impressive 15.23 times. This upward trend indicates that Nestle has become significantly more efficient at collecting receivables. Now, let's look at Dutch Lady. Their account receivable also shows a positive trend. From 2.265 times in 2019, they have climbed to 15.699 times in 2023. Similar to Nestle, these demonstrate improved efficiency in their collection process. These bar charts provide a clear visual representation of the progress both companies have made. The higher the account receivable turnover, the faster a company is collecting its receivable. Both Nestle and Dutch Lady have shown consistent improvement, suggesting stronger credit management and potentially healthier cash flow. This is a positive sign for both companies. This slide analyzes the average collection period, also known as Days Sales Outstanding, for Nestle Dutch Lady from 2019 to 2023. It reveals how long it takes each company to collect payment after a sale. Account receivable divided by average daily credit sales decreased from 23 days in 2019 to 24 days in 2023. This indicates faster collection of receivable. Decrease for 35 days in 2019 to 22 days in 2023, also demonstrating improved collection efficiency by Dutch Lady. Bar charts effectively present the account receivable divided by average daily credit sales trend for both companies over the 5 years. In a sense, both Nestle and Dutch Lady have significantly improved their ability to collect payments from customers over the past 5 years, leading to a shorter collection period. This signifies enhanced cash flow management and potentially stronger financial health. This slide analyzes the inventory turnover ratio for Nestle Dutch Lady from 2019 to 2023. This ratio measures how efficiently a company manages.
Based on the profitability ratio analysis, the gross profit margin GPM has shown a declining trend over the years, indicating a decrease in profitability. Key observation: first, data set. GPM dropped from 37.57% in 2019 to 30.92% in 2022, before slightly recovery to 21.64% in 2023. This suggests increasing cost of goods sold (COGS) or lower pricing strategies affecting profitability. Second dataset, GPM significantly fell from 37.94% in 2019 to 26.54% in 2022. The steep decline in 2022 could indicate operationally insufficiency or external market pressures. Conclusion: the overall trend suggests profitability challenge over time, possibility due to rising costs, change in sales strategies or market conditions. However, the slight improvement in 2023 indicates potential recovery efforts. To improve profitability, the business should focus on cost management, pricing strategies, and operational efficiencies to maintain a healthy profit margin. Conclusion for operating profit margin (OPM) analysis. The operating profit margin (OPM) has shown a significant decline over the years, indicating increased operational costs or reduced efficiency in generating profit from sales. Key observations. First dataset, OPM dropped from 29.13% in 2019 to 13.32% in 2023, showing a steady decline. The sharpest decline occurred between 2021 and 2022, suggesting higher expenses or lower revenue growth. Second dataset, OPM fell from 30% in 2019 to only 4% in 2022, before slightly improving to 7% in 2023. This indicates challenge in maintaining profitability despite some recovery in the latest year. Conclusion: the continuous decline in operating profit margin suggests rising costs, pricing pressures, or insufficiencies in operations. While there was a slight improvement in 2023 profitability, remains much lower than previous years. Moving forward, the company should focus on cost control, operational efficiency, and revenue growth strategies to improve margins and sustain profitability. Conclusion for net profit margin (NPM) analysis. The net profit margin (NPM) has generally declined over the years, indicating challenge in maintaining profitability after accounting for all expenses, including taxes and interest. Key observations. First data set, NPM declined from 12.19% in 2019 to 9.36% in 2023. The lowest point was in 2021, which is 9.31%, but a slightly recovery was seen in 2023, which is 9.36%. Second data set, NPM dropped from 9.65% in 2019 to 3.55% in 2022. Although 2023 saw an improvement to 5.01%, it remained much lower than previous years. Conclusion, the declining net profit margin suggests that despite generating revenue, higher operational costs, tax, or other expenses are eating into profit. The slight recovery in 2023 is positive sign, but overall profitability is weaker than in previous years. Moving forward, the company should focus on cost reduction strategies, improving operational efficiency, and optimizing pricing models to sustain and improve profitability. The image presents profitability ratios, specifically returns on equity (ROE) for two different datasets over the years 2019 to 2023. Below are the key conclusions. First dataset, left side. The ROE values are consistently high, ranging from 97.77% to 101%. The company has maintained a very strong profitability performance, indicating efficient utilization of equity. A slight fluctuation is observed, but overall, the company sustains profitability at an exceptional level. Second dataset, the ROE values exhibit significant fluctuation, starting from 71.29% in 2019, dropping to 44.04% in 2022, rising again in 2021, and slightly recovering to 16.56% in 2023. This indicates inconsistent profitability performance over the years. The drastic decline in 2022 and 2023 suggests challenge in maintaining earnings relative to equity. Overall, conclusion. The first dataset shows strong and stable profitability, reflecting high efficiency in generating returns from equity. The second dataset, however, demonstrates volatility in profitability, which may indicate operational inefficiencies, change in market conditions, or financial challenge. If both datasets represent different companies, the first company is performing significantly better in terms of profitability. If they represent different divisions of the same company, one segment is stable and strong, while the other struggles with inconsistency. Strategic improvement may be needed in the weaker dataset to stabilize ROE and improve financial performance. The image presents return on asset ROA, return on investment ROI for two datasets over the years 2019 to 2023. Below are the key conclusions. First dataset, left side, the ROA shows a declining trend from 34% in 2019 to 18% in 2023. The lowest ROA was in 2022, which is 17.4%. But there was a slight improvement in 2023 despite fluctuation. The company maintains a relative stable ROA above 70%, indicating consistent asset utilization. Second dataset, right side, the ROA is highly volatile, starting at 23% in 2019, dropping to 40% in 2020, peaking at 35% in 2021, then plunging to 5% in 2022, and slightly recovering to 7% in 2023. The drastic fluctuation indicate inconsistent profitability and efficient asset utilization in certain years. The sharp decline in 2022 and 2023 suggest financial challenges or inefficiencies that need to be addressed. Overall conclusion, the first dataset shows stability in ROA with a manageable decline over the years, meaning the company or division has a stronger asset utilization strategies. The second dataset exhibit extreme fluctuation indicating potential instability in operation profitability or investment efficiency. If this represent two different companies, the first one is performing better in maintaining asset efficiency, while the second one needs strategy improvement. If these are different divisions of the same company, then one segment is stable, whereas the other requires a better financial and operating strategy to ensure consistent ROA growth. The company should analyze the cause of instability in the second dataset and implement corrective measures to enhance performance.
Good afternoon, everyone. Today, I'm Hafizan Today, I will be presenting an analysis of the leverage ratio of the two well-known companies in the food and dairy industry, Nestle and Dutch Lady. We will examine three key leverage ratio, the debt to equity ratio, and time interest earned. This analysis will help us understand the financial stability and risk management strategies of this company over the past 5 years. Debt ratio analysis. Let's begin by looking at the debt ratio, which measures the proportion of the debt to total asset. Higher debt ratio indicates greater financial leverage, means the company relies more on the debt for financing. As we can see in the table for the Nestle debt ratio trend on 2019 until 2003, from this trend, we observe the Nestle maintained a relatively low debt ratio from 2019 to 2021, average around 17 to 19%. However, in 2022, there was a significant increase to 26.29%, and it remained at 25.87% in 2023. This suggests that Nestle increased in its reliance on debt financing in recent years, possibly due to the expansion strategies, investment, or operational needs. Now we look at table Dutch Lady debt ratio trend on 2019 until 2023. Dutch Lady debt ratio has been consistently low, indicating a very conservative approach to debt financing. Over the years, the company has reduced its reliance on debt, with the lowest ratio in 2022 at 1.02%, followed by a slight increase to 1.16% in 2023. Nestle has maintained a moderate debt ratio, which a recent increase, while Dutch Lady has consistently kept its debt level very low, indicating a strong equity based and lower financial leverage. Now we move to debt to equity ratio analysis. Debt equity ratio analysis is measure the proportion of debt relative to shareholder equity. A higher ratio suggests that a company is more reliant on debt financing. Nestle debt to equity ratio trend from 2019 to 2023. Nestle debt to equity ratio has seen a significant increase, particularly in 2022, when it peaked at 149% before slightly reducing to 137% in 2023. This indicates increased financial leverage over time. For Dutch Lady debt to equity ratio trend 2019 to 2093, we can see the number in contrast. Dutch Lady has maintained a very low debt to equity ratio, which significantly declined after 2020. The low ratio suggests that the company primarily relies on equity rather than debt for financing. Nestle increasing debt to equity ratio indicate greater use of leverage, whereas Dutch Lady has adopted a conservative financial strategy with minimal debt. Now we look at to time interest earned. Time interest earned analysis is a ratio indicates how well a company can cover its interest obligation using its operating earning. A higher TIE ratio means the company is in a better position to meet its interest expenses. For Nestle, we can see the times is increased. Nestle has consistently maintained a strong TIE ratio. There has been a gradual decline over the years. The drop from 22.42 times in 2019 to 15.48 times in 2023 suggests increasing interest expenses or lower earning before interest and tax. For the conclusion is, will Nestle still has a solid ability to cover its interest payment? The decreasing trend may indicate a rising debt burden or lower profitability. Conclusion for the all leverage ratio is to conclude the leverage ratio analysis of Nestle and Dutch Lady provide valuable insight into their financial health. Nestle leverage has been increasing, indicating higher reliance on the debt financing, whereas Dutch Lady maintain a highly conservative financial approach with minimal debt expenditure. Understanding this trend helps investor, stakeholder, and analysis assess the financial risk and sustainability of this company. I will be So now, I will move to comparative analysis of the two major companies in the food and dairy industry, which is Nestle and Dutch Lady, based on their financial performance in 2023. We will examine their liquidity, efficiency, profitability, and leverage ratio to gain insight into their financial health. So, liquidity ratio. Let's start with liquidity ratio. The current ratio for Nestle is 0.961, while Dutch Lady stand at 0.799. This means Dutch Lady has a slightly better ability to cover short-term liabilities with its current asset. However, when we look at the quick ratio, Nestle has a marginal advantage at 0.38 compared to Dutch Lady 0.321, meaning Nestle has a slightly stronger position in liquid asset after excluding inventory. Now move to efficiency ratio. Moving on the efficiency ratio, Dutch Lady has a higher account receivable turnover at 15.969 times compared to Nestle 15.23 times, meaning Dutch Lady collect receivable faster. Their average collection period is also shorter at 22 days compared to Nestle 24 days. However, Nestle has a better inventory turnover at 8.48 times, indicating more efficient inventory management in terms of the total asset turnover and fixed asset turnover. Nestle outperformed Dutch Lady, showing it utilize its asset more effectively. Profitability ratio. Profitability ratio is a key indicator of business success. Nestle has a higher gross profit margin at 31.64% versus Dutch Lady just have 29.69%, meaning Nestle is earning more profit after accounting for production costs. Nestle also has a significantly higher operating profit margin at 13.32% compared to Dutch Lady just 7%, and its net profit margin is stronger at 9.36% versus Dutch Lady just 5.0.1%. This means Nestle more efficient at converting revenue in profit. Additionally, Nestle shows superior return with an ROE of 97.77% and ROA of 19.49% compared to Dutch Lady 16.56% and 7.64% respectively. Leverage ratio. Nestle has a much higher debt ratio compared to Dutch Lady, indicating it relies more on debt financing. Similarly, its debt to equity ratio is showing Nestle is highly leveraged. However, Dutch Lady has a stronger time interest earn ratio compared to Nestle, meaning Dutch Lady is in a better position to cover interest expenses. Conclusion for all of this is Nestle outperformed Dutch Lady in most financial aspects, particularly in profitability and asset utilization. However, Dutch Lady has a stronger liquidity position and lower financial leverage, making it less risk in terms of the debt obligation. Investors seeking higher return may favor Nestle, while a risk-averse investor might prefer Dutch Lady due to its lower debt level and higher interest coverage. Thank you. That brings us to the end of my presentation. Thank you for your attention.